Hello and welcome to this session in which we will start to discuss international taxation. The first concept we're going to learn about today is something called permanent establishment or PE. This concept is critical for taxes when it comes to business across borders. So when you're operating across borders, let's assume you're a US company. You are operating in Canada, you're operating in Europe, you're operating in Japan. Well, do you have a permanent establishment? Why? Because once that permanent establishment is determined, when a company's activities in a foreign country become substantial enough, then it's going to trigger taxation. It requires taxation in that country in addition to your home country. So you are taxed in your home country and you triggered taxation in another country. Why? Because now you have a permanent establishment. Now, what leads to permanent establishment? Let's look at a few rules. One is you have a regular business activity in that country. A company triggers PE status when it engages in business activity on a consistent, ongoing basis. This means what? This means you're not doing one-time transaction, but rather you have a stable business, continuous business presence in that country, regular business conduct. Two, you have some sort of a physical presence, and that presence is permanent. So you established a physical location in that country. That physical location could be an office, could be a factory, could be a warehouse. You have a presence. And your business operation through the foreign location. And it's not only you have a business location, you are conducting business. You are operating the business through that location. This means a significant business activity decisions or services are carried at or from that site, whether that site is an office, factory, or warehouse. So once we establish permanent establishment, now how does it reveal itself? This is what we're going to be discussing next. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Let's go ahead and get started. So the best way for that permanent residence for individual to establish itself is through a foreign branch or a foreign subsidiary. So you have fixed places of business. You have a physical location. And when you operate overseas, how do you operate? You operate through a branch. You open a branch of your business, or you have a subsidiary. So we need to know the difference between foreign branches and foreign subsidiaries because it makes a difference how the business is taxed. The first thing is foreign branches are extension of the parent company operating in a foreign country. Think about a tree. Okay, the tree has branches. Okay, so the branches are part of the tree. So the branches, you are part of the main company. You are not a separate legal entity, but you are part of the parent company conducting business under its name. Foreign subsidiary, when you have a subsidiary, unlike branches, they are a separate legal entity. So they're not part of the main company. It's a company that we own or we have shares in. Although they are owned by the parent company, but they're not part of the company. They operate under local laws and have their own management structure, but their activities can still create a PE for the parent company, permanent establishment, if you meet certain condition. Then you could also have presence through virtual economic presence. Now in the digital age, this is becoming more and more common, but just you have to know that sometimes the virtual presence could give you a PE presence. It could, without even having a physical location. This means that if you are using a website, online sales, significant online sales, you have a website in that country, it might trigger taxation in that country. Now, let's take a look at a quick example. Let's assume Tech Globe Inc., a US-based software, decides to expand its operation in Europe. It sets a small office in Paris. Well, this is a physical presence where a team conduct business on regular basis, so regular business conduct, to adapt its software for the European market and support local client. And well, we're doing business operation through foreign location. We have a permanent presence here. We have a permanent presence. Despite that the headquarters is in the US, its continuous systematic business activities in France through the office could qualify it as a PE, subjecting this company to the French corporate tax system. Moreover, if Tech Global also create a website in France, a localized French website generating substantial sales to French customers, this significant digital presence may also be considered a PE under some tax treaties. Now remember, there are different type of tax treaties between countries. Although you may not have a physical presence, because of the virtual presence, it might trigger some tax effect. Now bear in mind, there are many types of treaties. There are treaty variation. We don't care about, treaties between two countries, but it's important to note that specific criteria and definition of a PE can vary between different international tax treaties. How I treat you have a permanent establishment depending on the tax treaty between the two countries. So countries negotiate these treaties to outline how cross-border business activities are taxed, to avoid double taxation and to prevent tax evasion, to make sure both countries are aware of what's going on, so there is no tax evasion taking place, especially through transfer pricing. Therefore, the exact rules and implication can differ based on the treaty between the home country and the host country and the country where you are conducting business. Let's go back and talk a little bit more about branches. A foreign branch is essentially an extension, as I told you. It's the branch of a tree of the parent company, but they operate in that country without forming a separate legal entity. This means the branch financial activity is directly linked to the company. Now we need to learn about the tax implication of having a branch in a foreign country. What are the tax implications? Well, first is taxation of profit. The income earned by that branch is treated as if it was earned by the parent company itself. Remember, it's a branch of the company. This means the parent company must report the branch's profit or losses on its own tax filing, and these profits are subject to tax in the year they are earned. It's if they earned it in their own home country. Also, if they incur losses by that foreign branch, they can use those losses to offset income earned by the parent company in the home country, potentially reducing the overall tax liability. Now, if they pay taxes, which they will, the parent can claim credit for taxes paid to the foreign country on the branch's income. And this credit, we're going to talk about its limitation later. It's limited to the lesser of the actual foreign taxes paid or the amount of tax that would be paid on the income in the parent home country. Don't worry, we'll talk about the foreign tax credit and its limitation later on. Profit repatriation. What does that mean? Profit repatriation. So when a foreign branch remits profit back to the parent company, this remittance is not considered a taxable event. Hold on a second. So are you telling me it's tax-free? Not at all. Remember, when you made the profit was taxed. So when you send the profit back, let's assume a US company operating in Europe, they have a branch in Europe. So that branch, as they make the profit through that branch, they pay taxes. So when they send the money back, that money is not taxed. So however, the foreign country may impose a branch profit tax on these remitted earnings, which is essentially a withholding. So the foreign country can, ask you to keep some as withholding. That's different. Also, when you send the money, and if there's any foreign currency gains or losses, those are recognized. In other words, you had €1 million, and that €1 million was worth 1.5 million US dollar when you paid the taxes. Now, when you send that €1 million to the US, it was worth 1.75. So it increased 250,000 in value, and that's due to the foreign currency exchange. Well, you have a gain on that foreign currency exchange. Same thing, if you had a loss, you would recognize the loss. But the money itself was already taxed. Let's take a look at an example. Global Tech, a US-based technology company, establishes a foreign branch in Germany to offer its services to the European market. And they earned $1 million in profit for that year. What's going to happen immediately in that year? The Global Tech must report this $1 million in the US and pay taxes on it in the US. Now, the $1 million is also subject to the German corporate tax because it's operating in Europe, and let's say the German tax rate is 30%. So they paid $300,000 in Europe. What's going to happen is this. In the US, they're going to bring this $1 million in profit, and let's assume in the US, the tax on that is $350,000. What's going to happen? The US tax is $350,000. They paid $300,000 in Europe. They're going to get credit for that $1 million, and what's left is $50,000 to pay. Now, eventually, when Global Tech transfer the after-tax profit back to the US, there's no additional tax. It could be 2-3 years down the road. One more time, Germany might levy a branch profit tax on the remitted income. They might ask you to keep some money, a form of withholding. That's a different story. Now let's talk about foreign subsidiaries. A subsidiary is different than a branch. Subsidiaries operates as a distinct legal entity. It's not an extension of the company. It's separate than the parent company, established and governed by regulation of that country in which it resides. Unlike a foreign branch, again, it's an extension of the parent company, a foreign subsidiary, financial and legal obligation are primarily its own under the jurisdiction of the host country. Now you have a foreign company, you own part of it, it's part of your subsidiaries, but it's not part of your company. What are the tax implications for a foreign subsidiary? Well, there's the deferred taxation aspect. Profit generated by that foreign country are taxed by the host country where it's operating. That's obvious. If you're operating in Europe, it doesn't matter whether you're operating as a branch or you're operating as a subsidiary, you have to pay taxes. However, if you're operating as a subsidiary, you can defer paying taxes on the US side until you repatriate that money. So for the parent company, these profits are not subject to US tax until they are repatriated, brought back to the US as dividend. And this deferral gives the company some flexibility, allow the US parent company some degree of control over the timing of the US tax obligation on foreign income. So if they don't want to pay taxes in the US, they don't bring the money back from that subsidiary. They can delay this process. Now, bear in mind, some type of income, such as passive activity income, cannot be deferred and are subject to immediate taxation. Now, why? Because think about it. If that was the case, many investments are easily transportable, like money, stocks. You put them in Europe or you put them in low haven tax country. That's not acceptable. Those passive income, they are automatically taxed in the US. This is to prevent companies from indefinitely avoiding US taxes on certain type of easily movable income. Money, stocks, you can easily move them. Those are passive income. They are taxed immediately, whether it's a foreign subsidiary or a foreign branch. Transfer pricing regulation to ensure fairness and prevent tax evasion. Transaction between the US and the foreign subsidiary must adhere to transfer pricing rule, which we talked about. And the reason is why. to make sure that the terms and prices of the transaction between the related entities, the parent and the subsidiaries, reflect those that would be made between independent entities. So you're not really giving yourself a favors to do what? To reduce the overall tax bill. So non-compliance could result in significant penalties. Again, we talked about transfer pricing. Example, consider Innovatech, a US-based electronics which establishes a wholly owned subsidiaries in Germany. So to do what? To manufacture parts. So it's separate subsidiary. So this Innovatech is incorporated under German law, making it a separate legal entity. The taxation, well, if the company earned $2 million in profit, these profits are taxed in Germany according to the German corporate tax rate, whatever that corporate tax rate happens to be. The US does not tax these earnings at this stage. When does the US tax these earnings? When they get repatriated. If Innovatech Germany decides to distribute $1 million in dividend back to its Innovatech US, well, this repatriated income becomes taxable in the US. You may receive credit for taxes paid in Germany. Nevertheless, this is when they are taxed. Bear in mind, any passive income earned by that subsidiary, let's assume they earn $200,000 in passive investment income. This passive investment income is immediately taxed in the US, regardless whether it's repatriated or not. You can't get away with that. Now, If Innovatex sells raw material to the German subsidiary, the pricing of these transactions must align with the market rates to comply with the transfer pricing rules. If the US deems the prices to be artificially low or high to minimize taxable income, penalties could be imposed. Again, we talked about this in a separate recording about transfer pricing. Let's take a look at this multiple choice questions from farhatlectures.com. When are profit of a foreign subsidiary recognized for US tax purposes? Is it as soon as the profit are earned in the foreign country, only when the profit exceeds a certain threshold, when the profit are repatriated to the US as dividend, annually regardless of the repatriation? So if we own a foreign subsidiary, it's a US company and owns a foreign subsidiary in Europe, when that income, when that profit from the subsidiary is recognized, it's recognized when the profit is sent back to the US as dividend. So the answer is C. It's not as soon as the profit earned in the foreign country. This is if you operate as a branch, not as a subsidiary. Only when the profit exceeds a certain threshold, there's no threshold. Annually regardless of repatriation, again, annually regardless of the repatriation, it's like A, which is a branch. So the answer is C as in Charlie. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you prepare for your exam, CPA exam, accounting courses, any certificate or professional designation you are investing in. Good luck, study hard, and invest in yourself.